just before we get into the conversation, I'm just going to give everyone a 1 minute opportunity to introduce themselves. So for those of you that haven't met the panelists in the room, you know where they'll be speaking from, otherwise a bit out of context. So Zach, do you want to go first?
I'll just use your mic. Oh, is mine on? Yeah. Zach Jordan, Launch Africa Ventures, an early stage Pan-African fund that's invested in 133 startups across 22 African countries in the last 3 years.
Succinct. Brendan Mullen, co-founder, managing director of Secha Capital. We're a growth stage impact fund. First fund was a $5 million 12J. We are now investing out of our second $50 million fund.
Hi, I'm Natalie Kolbe. I'm the managing partner for Norskeen 22. It's targeting to raise $200 million, so it's a growth stage fund for Africa. We've got about 160 raised so far.
Hi, Akash Maharaj, an executive equity finance investments business at Standard Bank, more focused on the investments piece and having invested in a number of venture funds across the continent in the last year.
Great, thanks. Myself, Allison, MD of Devon, Africa. Sorry, the mic keeps jumping in and out. But we as Endeavour, we work with more than 200 entrepreneurs across Africa and globally. Our fund that we manage out of the US, the most recent raise was $300 million. And we invest in businesses that we work with across the globe in emerging markets. Okay, so first of all, I just wanted to say, like, obviously in the panel, we've got a whole lot of investors in the panel, not so much entrepreneurs. In the room, we've got many entrepreneurs and a handful of investors. So just wanted to, first question for Akash, just wanted to say if you can explain why exits are so important for us as investors and also puts us on the same side of the table as the entrepreneurs.
Yeah, I mean, maybe for context here, I've invested in a number of funds, like I said earlier, for Standard Bank across the continent. And when we allocate capital to fund managers, that same question is, comes through at all our committees. It's the key focus for any engagement where we can get approval. And it really is about showing that there's credible cash back after an investment. I put on a note here saying investing is easy, exiting is hard. And I think that's the critical piece that we look for when we're evaluating fund managers. And I guess it's exactly the same that the fund manager needs the exit to be able to roll cash back to their investors. And so the virtuous cycle can go on. So I think from our perspective, I think the things we look for, again, in the fund manager is that ability to say at the start of the investment very clearly what is the exit path, having agreed that with the underlying companies. That's a critical piece for us. And then how does that get executed on over the course of investment? So how do they stay true to that as they engage? It's a critical piece for us in the evaluation of the allocation of capital.
Super. So I always, back in the days when I was an entrepreneur, it was always really heartening to know that the VCs were there with you to support you actively in finding that exit, because it's just as much in their interest as yours and the entrepreneur. So I want to say for the next question, just going to go down the line, starting with Natalie, and really talking about, like, if we had to put an entrepreneur onto this panel, which entrepreneur would you choose to be here to tell their story of exit and why?
Yeah, Allison, I mean, I think the story of Africa being an attractive place for international strategics to acquire and to really, find growth on the continent, I think is one that is super exciting. I mean, I think there's a lot of activity that happens in the continent. Zach has pulled some fantastic data for us that he's going to talk to. But really, with Africa being kind of the next frontier, the real growth frontier, international strategics looking for that growth and acquiring in Africa, I think is a great story. So the story that I would like to tell or have the entrepreneur tell is Stripe's acquisition of Paystack. That was a $200 million acquisition. It was one of the first, the biggest startup acquisition that happened in Nigeria at the time. It was also the biggest acquisition that Stripe made, which is interesting, into Africa, not anywhere else on the continent. And also the journey that partnership took, where Stripe was invested early on, and really got to know the business over time, and then had the confidence to invest. And that's a double-edged sword, and we can talk about that. Having a strategic investor alongside you, it can go both ways. Obviously, this worked out for them, so that I think is a really good story. It's one of the highlights of the exit scene for Africa.
No, agree. And also what that did for putting Africa on the map for many others, it was, I think, super, super powerful for the rest of us in the room. Okay, so then Zach, over to you. Who would you call as the next entrepreneur that you'd want up on this panel?
Yeah, I mean, I definitely get. I mean, Stripe was a watershed moment in African M&A from a tech startup perspective, but just 2 months ago with the InstaDeep acquisition by BioNTech in Germany, that made Stripe look like a kindergarten kid. It was almost $700 million. At the start of probably the biggest bear run in the history in recent history. So that just showed how Africa could be potentially counter-cyclical to what's happening globally from an M&A perspective and from a capital raising perspective. So I'd love to have the co-founders of InstaDeep here. Also very, very strategic investors that invested at the A, the B, and the C, and then finally the acquisition. So, yeah.
No, and lots of learnings for us in how they went about developing that relationship. But Brendan, for you, I mean, you play in a slightly different sector to the other VCs that are here.
Yeah, sure. And then with that in mind, maybe share a different type of story, at least certainly different from a size. So our first entrepreneur that we invested in, we just recently exited. By recently, I mean this week. And it was an MBO. And it was the only time she raised capital. It's in the black hair care market. We were invested for about 5 years. And we have a nice return. It's a 6x, 42% IRR. Before your eyes get that wide, the number was below 10 million rand. But for us, that's a massive return. And she still holds her company and gets to run it as she sees fit. So I'd much rather these returns, but it also kind of exemplifies our place and that there's another path, right? So she's now creating wealth on her own. She made our investors happy. And it still, has an opportunity to be a massive kind of African story, African grown brand.
And also really interesting to hear of stories where the entrepreneurs only raised, a relatively small amount of capital, owns the most of their business in a great space, and therefore you can control your own destiny. So there's a lot of that in how you run your business too. But sort of moving on to the next topic, just looking back at what exits have happened in Southern Africa, in Africa for the last. I mean, if we take it back to the early days, 99, when Shuttleworth did his big exit, people were thinking, hey, the space might really get moving. And then since then, there have been a number of exits, but far, far smaller. I mean, if we look at that transaction, when he sold Thought to VeriSign, today that would be worth $900 million. Okay, so still one of the biggest exits, right? But that was more than 10 years ago, okay, where we sit today. There have been 1 or 2 big exits in South Africa since then, but the big exits have actually come from other parts of Africa. So I want to say just, Zach, you called out the InstaDeep exit. What are your views on these trends, like what we have seen in the past 3 years, Southern Africa versus rest of Africa, and where do you see it going?
Yeah, so I think to make it easier, if it's not too technical, I'll just share a couple of numbers that I pulled on the flight today from Cape Town. It talks about the actual number of exits that have happened in Africa tech over the last 4 years, and this is from the big deal that Max Bain and Max Collier write. So it's pretty well thought of and researched. So there have been 38 exits in South Africa in the tech space in the last 4 years. The largest one of them, and by the way, a lot of these are not disclosed. So the numbers you see are for the deals that were disclosed. So the largest exit was Time Bank buying Retail Capital for 1.5 billion rand. So it's at the time just over $100 million, right? So that's a pretty sizable exit. And again, what's interesting, and Allison made a good point here, is what's the time to exit, right? So Retail Capital started in 2010, so that's 12 years to exit. People talk a lot about AdDynamo. AdDynamo sold to LF Holdings for $30 million, but that happened in 22 years, from 2009 to 2022. The third biggest one was Yuppie Chef selling to Mr. Price. Again, 25 years to exit. And they sold for $31 million. So there have been a few good exits in South Africa. Anything above $100 million, tough. Retail capital was an exception. So it's not just the amount at the time of exit, it's also how long it took to exit. If you look at markets like Nigeria, so what's interesting about African tech, and Nat, thanks for bringing up the pay stack thing. Africa has had 11 unicorns in the last 5 years. 3 of those are no longer unicorns because they were listed. And that's a separate discussion about like listing versus M&A. What's a better way to look at liquidity? But the time to unicorn status, and this is your Endeavor report, which I'd absolutely loved reading, is shorter in Africa than anywhere else in the whole world. I'll just have to shout now, it's cool. So on average, it takes, on average, and averages can be misleading, but we've got a relatively small sample size, 4 to 5 years to get to a unicorn status in Africa. Yes, 11 companies. So from that perspective, the addressable market is significantly bigger because there are so few players. The time it takes to get to threshold sort of terminal velocity in Africa is a lot higher. So that's one of the reasons why investors getting in early can get pretty outsized returns on the African tech scene. So.
So one thing just calling out, like there's this really big bunch of exits that have happened, but over many years, right? So it's 15 to 20 years of building and then exit probably at below that massive threshold that you'd be calling out, but then you've got this other extreme where you've got the shortest amount of time through to being a unicorn. So it's really, but just know this is the market that you're playing in when you're in Southern Africa and Africa. They're two ends. The other piece maybe, look, and I don't know, Akash, how you think of answering this question, but the other piece I found interesting when you look at these exit trends over the past 3 or 5 years is who were the buyers? Okay, so there's a handful of IPOs, but otherwise the corporate activity is quite big, and there's probably more buyers out there in the corporate space. Now we're seeing buyers coming from other fintechs. But anyway, interested to hear your views, Akash, on what you've been seeing.
Yeah, I actually reached out to one of the fund managers that we backed, have done probably the most number of exits in South Africa anyway. And kind of interesting things that he was saying to me was, the exits were largely B2B plays in the South African context, and he sees that just by virtue of the fact that most of the startups have a healthy corporate market here, which they can act as customers, and so they build businesses in that space. And if you look at the exits, are very much characterized, along those B2B lines, versus Africa, where it's much larger consumer markets in Nigeria, for example, and so you can build B2C players and you can get those kind of exits as well. So that was the one interesting point. Obviously, ex-con is an impediment in the South African context. I don't know many buyers, and certainly we've seen it in portfolio companies we've had as well. Historically, the businesses need to then re-domicile before that final transaction takes place, which just takes a long, long time and puts a buyer off. I think just the valuations across the continent have been relatively high for a long period of time. It obviously turns off buyers because it's at the end of the day you got to think about the value on the table for the buyer, and that needs to be a coherent story as well. And I think it's interesting as well, the South African context, you've got a high cadence of smaller exits. There actually have been, we looked at that list this morning, when you look at the number, it's quite significant. Whereas obviously Africa, you have these larger unicorn style exits.
Yeah. Zach?
I just want to quickly add that not all exits have to be cash exit. In fact, the vast majority of exits are stock exits, right? So it is humanly impossible. Musical chairs on the mic. It is humanly impossible to put a dollar value to what these exits are worth. So everyone talks about the Stripe exit being $200 million. That's factually not 100% true, because that was 50% stock, 50% cash, and Stripe's value skyrocketed after the acquisition. So that acquisition happened in July of 2020. Obviously, we had a massive bull run in the market, and the investors that sold in the secondary market, sold their Stripe shares, actually made almost 2.5 times the cash price. So, but some investors chose to hold, and they got screwed because they were forced to sell earlier this year or last year when Stripe tanked. So it's interesting to look at cash versus stock. And personally, I mean, as a VC fund manager, I would tell my portfolio companies to look at, depending on who's buying you, if Flutterwave or Kuda or a Chipper maybe a little, I'm not too sure about Chipper right now, is buying you, I'd rather weigh more percentage in stock, because a cash acquisition, you know exactly what you're getting. With a stock acquisition, I know investors in Paystack that effectively sold for $600 million because they sold their Paystack shares about a year after the acquisition. Work the math out, right? So that's an important thing to also keep in mind.
No, so for the next question, just Natalie, Brendan, I just wanted to turn it to you guys. So just honestly looking forward. So right, exits can come from IPOs. Looks like the IPO market isn't so open. But then if we read what's happening in Middle East, maybe there actually are some interesting opportunities that are still happening there. There was a nice article in the FT earlier this week talking to that point. I mean, but the other point is that capital markets, it's tighter, cost of money is higher. That being said, the South African corporates, many of them, they've had better performance over the past year. I mean, you hear from Standard Bank, so I'll call out Standard Bank's figures. I thought really, they've had their best year yet, up 37%, and reported 34 billion rand of headline earnings. I mean, these numbers are massive. So, and it's the same thing that we're seeing across a number of the banks. So there's cash there. So my question for you both is, where do you see this going? Like, where do you see this going in Southern Africa, and where do you see this going for Africa? So what should the entrepreneurs in the room be thinking about? Like, next 3 years, 5 years?
Yeah, Allison, I mean, I think the trend that, that Zach spoke to about corporate acquisitions, strategic acquisitions, is the trend. And certainly when we're investing in a business, we always look at who could buy this from a corporate and strategic perspective. If your only exit is an IPO because you can't see any other strategics out there that can buy it, then we would think twice about that acquisition. It doesn't mean to say that an IPO is not a possible exit route. It absolutely is. And particularly if the businesses become very big. I think that's also something else that entrepreneurs should think of. We all want to grow big businesses. We all want to only exit when the business is really worth a lot. But at that point, is there somebody that can afford to pay $200-300 million for your business? That's 5-6 billion rand. I mean, there's not many companies in South Africa that's going to be able to pay for that. And similarly, even if it is an international strategic that's looking to come into the continent, they're also not going to want to potentially place such a big bet on the African continent. So again, thinking through the timing of your exit, and to Zach's point, you could potentially get stock in the next business where you can still continue to get that growth, I think is really important. So for us, we focus on strategic acquisitions. And I think what is going to be a trend in the next few years is consolidation within Africa, within the tech companies. What's happening, what we're seeing at the moment is you've got similar businesses in Nigeria, Kenya, in South Africa. They're all doing the same thing. They're all wanting to grow. And what they're doing is they're now moving into Kenya, South Africa, Nigeria. So they're all starting to bump into each other and trying to, claim turf. And that's just going to end up not great for anybody, right? So I think what will happen is that you'll find consolidation where you'll get Nigeria, Kenya, South African businesses consolidate and become African tech giants. And then in that way, we'll probably need to then go to the IPO markets. So I'd say those were probably the few trends that we'd be seeing here.
Great. Brendan?
Yeah, it's funny you mentioned the size of that and making sure there's a buyer. I spoke to a fund manager the other week in the energy space. They're on their 4th fund, and they've grown an asset so large that there is no secondary opportunity. And for a strategic in that space, it's probably not a priority in that market. So IPO is the only route for them, and nice problem to have, but still a tough problem for having grown that asset. So from our perspective, and what we share with the entrepreneurs is to have obviously a scenario, and to simplify it, I'll have our kind of bull case and then our base case. So the bull case, with how things are evolving, is maybe looking better, that the US is interested in certain sectors, US and Europe. And now with interest rates changing and TINA being over, there is no alternative to equity. what we're actually seeing is a little bit more interest of whether it be LPs or strategics, corporates in the US looking here because they just need some sort of growth. So that's exciting. Maybe anecdote, our latest investment's in a vertical SaaS agri company. We signed the documents Thursday last week. Later that day, we're on the phone with a corporate VC out of the US to kind of line it up. Now, is it gonna happen? I don't know, but that's a nice kind of bull case scenario. But on the base case, and again, different by sector and how you grow your company, I always mention, let's not forget about dividends. Like we've pulled dividends from a few of our companies, and that's going well, and the entrepreneurs are happy. And let's not forget about the secondary market. And what's key there, in order to have returns, is investing at a certain multiple metric, and then adding the value to the business so you can exit it. So one of our companies where our only other exit, not that we have that many, but our only other full exit, we invested in EBITDA multiple, and we exited our stake in a secondary sale at a revenue multiple. So really good result for us. Again, this one's, it's around 20 million rand. So nothing, the numbers we've been talking about there, we're a small fund. But that's a major payday in this environment for a company that didn't have a burn rate, was profitable for a number of quarters, and is a valid path. Now, it might not work if it's a winner-take-all market, but in FMCG, manufacturing, and parts of agri, like that's a great scenario. And again, I think part of the question was not just entrepreneurs, but us. We're hoping to have a bunch of 3 to 5 X's in our portfolio, or the majority, as opposed to a third on base, a third strikeouts, and a third 10X. So that's just our different kind of view on portfolio construction.
No, and I want to say those points on thinking about a business and growing it to being EBITDA positive and thinking about the day like you're paying dividends. That's not what the story is usually for high growth tech businesses. But I want to say at the same time, you've really got to think through where's the market at, what's possible, what makes sense for you now, and then do what makes sense for your business and for your shareholders, because different market situations mean different things. Sorry, I'm just getting, is it 2 minutes to questions? Perfect, okay, so last question for everyone on the panel, and I think what the different points that Natalie and Brendan just spoke through sort of lead into this question. So the last question is about what practical advice do you guys have as a panel, we'll just run down the panel, for the entrepreneurs in the room about setting themselves up well for exit? I mean, this could be a whole discussion in itself, but 1 or 2 nuggets from each. Akash, do you want to go first?
Yeah, sure. I think like a buyer. You got to get into the head of the buyer from day one. I mean, earlier on, I pointed out to one of the guys doing a pitch as well. Think like an investor. If someone's coming into your business, is going to want the money back, and they want return on that money. So you got to think about that very clearly when you're articulating your story for their situation, right? I think that's like almost the basic advice and the correct one I would give anyone. And then maybe seems obvious, but in this market, back to I think Allison's point, think about building a healthy, profitable business, because you have no idea how long this thing's going to take to exit a business, and your only protection is actually a business that generates cash for yourself. So if you can pay yourself, you have more leverage in any negotiation. So if you can't, and you're running out of cash, and you're burning through cash, you have no leverage. Yeah, and I think I would identify possible targets early, build a relationship early.
Great. Natalie?
Yeah, Allison, I'll put two points out. First of all, let me just think through your cap table about who you have around that table. If you've got a strategic corporate investor, you've got a permanent capital vehicle with long-term money, and you've got a VC that wants to exit, you can see how there's going to be a lot of competing wants and demands around that table. And you as the founder and entrepreneur is going to be stuck in the middle. And look, the good thing about a different type of investors around the table is that they bring different input, but they can also cause a bit of stress when you're looking to exit. So just think through that cap table very carefully when you're putting your investors together. The second point, and this is a really boring point that nobody ever wants to hear, is make sure you are running a clean house with proper governance. Nothing will destroy your business quicker and let you go from whatever your value is to zero as if you have a governance failure. And unfortunately, we're starting to see these coming through in Africa, and it is tainting the entire ecosystem. You know, we kind of get painted with international guys going, Africa corrupts, we're not investing there, because you get these stories coming out. And it's unfair, because these issues of fraud and corruption happen in other parts of the world as well. But it just gets highlighted when it's on the continent. So let's not fuel that bias, and make sure that you've got proper governance in place. And again, when you're exiting, you want to instill confidence in the buyer. And if you've got a proper business that's been run properly with proper governance, proper compliance, all the boring stuff that none of us want to pay attention to, you give confidence to the buyer, and they're therefore willing to pay more for your business. So it's a boring point, but I think it's a really important one.
Cool.
Yeah, I think those are great points. I'll just add two quickly. The first one is transparency and have your story and make it stick. I speak to a lot of entrepreneurs that don't want to talk to a future buyer because they might steal their IP, and maybe it can happen sometimes, but I assure you it's pretty rare, and they'd rather buy than build it themselves. And secondly, following governance reporting as well, but first for that reason, as well as know the KPI that you're going to be evaluated on in 3 to 5 years. And as long as it's also important for your business, focus on that. So whether it's, just thinking of our portfolio, whether it's consumer engagement online, basket size, ARR, those will be the numbers that some buyer's going to ask you in a few years. And if you can show that in longitudinal way, and you have a nice quick dashboard, nice chart, that's also great. VC and PE people are lazy, so make it easy. I'm just saying that to be, sorry. Thought I'd get a laugh. Make it easy for them to digest it and see that curve. And then it's also nice to look back and say, wow, we were there, now we're here. And so those sort of reporting measurements are huge.
Zach?
Since this is a Southern Africa summit, I'll try and make it more relevant to the region, and I can have a different answer when I'm in Dakar. So, as a South African or Southern African entrepreneur, we've unfortunately seen way too few South African companies that have expanded beyond South Africa. I have a pet peeve about this, and I often joke, but I'm not really joking, that most South African entrepreneurs have this virtual boundary beyond the Limpopo River, and they can't expand beyond it. Even one of our top South African startups, one of the most iconic South African startups, Yoko, 9 years on is still only in South Africa, despite them having heads of international expansion, but nothing actually happens. The problem if you're a South African startup or a Southern African startup is your TAM, your total addressable market, is really low. The 60 million people in the country doesn't cut it because only 4 million pay tax. So you have to think global from day one. This is what Nigeria and Senegal and Ghana and Tanzania and Kenya have gotten right in the last 7 to 8 years. They move their IP offshore on day 1, not day 200. And they have very clean Delaware holdco structures or UK holdco structures or Singapore holdco structures. Little things like that increase funnel of investors that look at you. So South Africa has had more number of exits, 38 in the last 4 years versus a Nigeria or a Kenya, but the value of those exits is significantly smaller. So don't be fooled by what you see. So you have to think global from day one. Take fintech, for example. Of all the top fintechs in South Africa, only a handful have expanded beyond South Africa. Now, Peach Payments is one of them. Does that mean that you have to set up a company in Nigeria or Kenya? No, you can work through partnerships, right? I say this often on panels. You have to learn as a founder the subtle but beautiful art of sacrificing margin for volume. So if you can share your revenue and a few basis points, shave a few basis points and partner with someone in Kenya or Nigeria through an affiliate partnership, that works so much better than trying to hire a team. And there's so much I can talk about this, but we've only got 2 minutes left. So I think that's my thing. You have to think global from day one if you want to look at an exit.
I want to say thanks so much. So we're going to hand it over to the audience for questions. Just one thing before handing it over. I mean, the theme I really heard was it's all about building the right relationships with knowing what's going on in your vertical and with the strategic buyers. So I just want to say, like, all the entrepreneurs out there, just get out there and get to know who your strategic buyers are. Like, what are they interested in? What size company do they buy? Know the ones that are in your local market and know the teams that are international if you're really planning to be, going big. And the last point on this is really get to know your competitors, okay? And I also often hear from entrepreneurs, maybe at an earlier stage, oh, they're going to steal my ideas. Like, no, guys. Like, honestly, we're only going to win if everyone wins in this space. So get to know your competitors, get to know what their value proposition is versus yours. You know, and I'm telling you, we'll grow this industry far better together than you will trying to, you know, hide something from other parties that are playing in a similar space in your market. So if you don't know them, just reach out on LinkedIn. It's like really simple. Sit down and like what you heard from the first speaker of the day today, just go and have a conversation with them, a business conversation about what's going on in your space. They won't see it as a threat. You'll both grow this industry together. And I think lots of those, if you build the right relationships out, you're going to find the right exit, whether it's earlier on or later on, just, you know, whatever stage your business is at. Okay, questions?
Cool. Thank you very much for that. So how the questions are going to work, we're going to start in the back and move the mic to the front. If the mic passes the row you're sitting in, it's gone forever. You're not getting a question opportunity. So raise your hands quite early. We're unfortunately only going to take 5, maybe 6 hands as we move on our way down. Yeah, are we good on that? Great. Can I see hands?
And just a big round of applause for Allison doing a fantastic job.
Yeah. I only see 2 hands. That's it? 3 hands? Great. We're going to start there. Please stand up. As I'm like we're doing a live stream. So
cool. How's it, guys? I wanted to ask a little bit.
Sorry, can you introduce yourself?
Yeah, sure. My name's Nick. I'm from a company called Gotbot.ai. Zach actually invested in our business in 2017. Yes, and we're still around, doing well. So, my question is, Zach, you spoke a little bit about moving IP offshore. When we obviously signed with you guys, the advice given to us was grow the business locally, look at it later, you know? And I understand that we were much younger and didn't have the experience. But as a South African, you're also looking at it, like I want South African businesses to do business with South African businesses because of the situation, right? But when you remove the IP and so on, there's no benefit to our country.
Okay.
For instance.
Can I?
Yeah.
Okay. Finish your question and yeah.
Yeah. And basically you're saying entrepreneurs in other countries remove the IP immediately. Can you talk to that a little bit and like advise us on like what you do from an ethics point of view, you know, wanting to help your country?
Let me just maybe just go for that first. So the IP and your operating team and where your operating team sits are 2 different things. Okay. So why are we saying have your IP in Delaware, have your IP in Netherlands, have your IP in UK? It's got nothing to do with not supporting Nigeria, Kenya, South Africa. It's actually got everything to do with supporting Nigeria, South Africa, and Kenya. Why? Okay, because the global VC market is going to, you need a lot of capital for your business to grow. Okay, so you need to have the best access to that capital, to get access to that capital at the cheapest price. And you want to have the best strategic capital investors coming into your business. Okay, sadly in South Africa, the local VC market here is a rounding error versus the global VC market. Okay, so Sequoia, Andreessen, Balderton, et cetera, et cetera, et cetera. Okay, the big capital sits internationally for growing high growth tech businesses. Okay, there is some capital here, so not wanting to say the VC market is much bigger in South Africa than what it was before. But what it's about is finding the best funding for your business so you can finance the team that you're going to have operating here in South Africa and building out your business. It's not about saying we're not in South Africa. It's actually saying, so about 90% of the businesses that we work with at Endeavour, their HQs are sitting internationally, 90% of their teams are sitting in South Africa. They employ thousands and thousands and thousands of people. They wouldn't be employing those teams unless they were here.
Everyone makes money, right? But when you sell, nothing's coming back into the economy because when you sell, surely the IP is housed somewhere.
So you mean sell in like 40 years' time, or you mean sell your IP? So your business wouldn't exist, right? So if you can't raise capital in your Series A or Series B, you'll never have a Series C. You'll never have an exit. Okay, so you need to make sure that you raise the capital along the way. And to raise the capital along the way, you want to give yourself the best chance to do that. That means set up in a place where the international VC market is very happy to put money into your business. because then you can employ the 200, the 500, the 1,000 people here in South Africa funded from Balderton or Sequoia or Andreessen or whoever it is internationally. Yes, finally at the end of the day, I'm going to talk to you about the tax agreements, but some of the money will come to South Africa, not all of it, okay, but some of it will come, but by the way, more the message is that day will never come if you never get the Series A and Series B along the way. But
I mean, listen, you've covered everything. There's nothing more I have to add. All I would say is, from a tax perspective, most Delaware or Netherlands situations with Nigeria and South Africa, no one's paying tax in the U.S. because you're not generating income in the U.S. You don't get taxed on equity. You get taxed on EBITDA, right? So you could have your IP sitting in Delaware, and Gotbot Inc. owns 100% of Gotbot Pty. Gotbot Pty pays all the tax in South Africa, so SARS is happy. You employ all your people in South Africa, so that's job creation. And PAYE and everything. So please explain to me how that's not being patriotic. You're being patriotic and you're being smart because you're getting access to capital from overseas. Otherwise, Bill Palladino told this to me once, you're a whale in a puddle, right? Because you're not even a big fish in a small pond, you're a whale in a puddle. There is a tiny VC market in South Africa. So.
Cool. Yeah. Can we have that mic moving down? This gentleman was second, there was a hand there, was third, and that's fourth. Can I just ask, how early is it too early to get an exit advisor?
After your Series A, if you want to be, I mean, most people, most M&A firms will not take you on unless you're doing at least $10 million in annual in ARR. The good ones, FD Partners, of the likes, yeah.
But
yeah, look who's on your cap table, ask them for help. But I mean, and I want to say, you also don't necessarily need an exit advisor. The chances are they're on your cap table if you're going for a smaller exit. Yeah.
Go ahead.
Cool. Thank you so much to the panel. It was incredibly insightful. My name is Adrian. I'm from ABSA next door. This is for anybody on the panel. I'm just curious what the closure of Naspers Foundry says about the VC market and exiting in Southern Africa. Is this mostly internal business motivation, or can we glean some insights from the event?
thing that works. There we go. I mean, that decision for Naspers to close down was entirely driven by an offshore entity, right? That had nothing to do, and it's absolutely no reflection on South Africa or venture capital in Africa. If you have a look at what happened in the world last year, Africa was the only continent, was the only market in the world that grew from a funding perspective into venture capital. So we've got a very vibrant and alive market share. Obviously, a capital leaving or no longer available is not great for the industry, but where a gap opens up, other capital will flow into that. So I think it's really important to know that decision was not taken on a South African issue. This was a global issue taken at Naspers head office level, where they were repositioning the way that they want to look at it. And this happens all the time, right? Corporates change their strategy all the time. They have shifted their strategy, and this has been the alternative to it. And other corporates will shift their strategy towards that. So I certainly wouldn't take that as a negative to South Africa. It was absolutely done at the head office level.
Yeah, and I want to say also there's a learning in that for all of us who take money from corporate VCs, because strategies change, right?
Cool. There we go. Thanks so much. Thanks.
Hi. So my name is Mkoli Sipoy. I'm the founder of Agile F. Half of my question. The other half of my question is for yourself, Zach. What has been the trends within the healthcare tech space? I know you've mentioned 38 exits, but in the shortest previous history, what has been sort of the trends in the healthcare space? Because that's a space that we're particularly playing in. And the other half, I think you've already answered with, which was at what point do you start getting exit advice? Thanks.
Is anyone here a healthcare expert? I can give some high-level advice, but I defer to anyone that is anyone here with specific healthcare. Okay. Healthcare. Are you talking about South Africa or Africa as a whole? South Africa. Okay. So the one good thing about healthcare in South Africa is we are run by oligopolies. There, I said it. Everyone's thinking about it. No one has the guts to say it. So we've got 5 big insurance companies in South Africa: MMI, Old Mutual, Sanlam, Discovery, Hollard, right? And they've got wings and legs all over the continent, right? So if you're sitting in Côte d'Ivoire, Senegal, or Cameroon, or Gabon, you will interact with Saham. What you don't know is Saham is fully owned by Sanlam. If you're sitting in Kenya and you have your life insurance or health insurance with UAP, you're like, oh, UAP, it's a Swahili acronym, but it's actually owned 100% by Old Mutual. So the health insurance and sort of non-life insurance market, actually not life and non-life, is run by oligopolies. And the same thing is true of HMOs. So Netcare, Mediclinic, and the likes. They've got arms and legs all over the continent. So it actually works really well if you're a South African healthcare startup and your distribution, and my friend Clive always talks about distribution. Distribution is the it can make or break you, right? So as a healthcare founder, a health tech startup, very early on, if you're able to work with health insurance companies that can leverage off of your tech, but you leverage off of their distribution at the expense of a few basis points from a margin perspective, you actually stand yourself in really good stead from an exit perspective. Because you've got oligopolies on the insurance side, health insurance side, and you've got oligopolies on the HMO side. So South Africa is ironically, despite its very oligopolistic market in this space, a really good case for exits to corporates. I can't guarantee they'll pay you a nice multiple, but they'll buy you.
Great. We've got one hand there, the final hand is Christoph's here. Can we keep it brief?
Hi guys, my name's Mitchell Fieldgate. I work for a company called Innovate Alternative Assets and Solutions. So you're on the investment side. We mainly are alternative asset brokers. So we're finding the best jockeys in the house and we race for them. We typically do more traditional alternative asset classes. We've dabbled in VC, but we kind of pick a jockey who's an expert in that area. Like we've worked with Knife Capital and Kalon. But now we're looking to venture more into our own deals where we invest directly into a VC firm. This question could help myself and also the entrepreneurs here, and that would be, when someone's pitching to you a VC idea or a business, what are some red flags that you pick up? Because obviously it is a bet. There's always going to be risks involved. What are some red flags that kind of put you off of an investment?
When the entrepreneur's bullshitting you, I mean, I don't know how to say that more politely, but I mean, we're not. It's not the first time we'll be doing this. We'll be hearing about, we get pitched at all the time, and I think it's a point that you made around just being transparent and just saying it like it is. Like this is what will go well, and this is where our problems are. The moment I feel that authenticity coming from the founder, then I start to relax, and the barriers go down on both sides. If you're in like full on pitch, I'm selling it to you, like immediately the red flags go up for me. So for me, that is the biggest red flag.
I mean, for me, I think if the entrepreneur doesn't understand the risks, or even it's a similar kind of thing for the fund manager, weirdly enough, but I think the entrepreneur doesn't understand the risks and isn't able to articulate them and tell me why he can get past them. He hasn't understood the market. And I think I look for that self-evaluation. Have I dug deep enough on the problem, and do I understand where the pitfalls are?
Maybe to answer it again, a slightly different way, I don't like the term pitch. We don't take pitches. We have conversations. And if somebody comes to us wanting us to invest, I should know a decent amount about that company, about that sector, the risks. Because also, I think we've created the system where we expect the entrepreneurs from day one to tell this story, and to listen to 20-minute VC, and to know how, to make sure they've looked at the ideal deck from Sequoia or from Stripe. And I think they should, but I don't think that's always a fair expectation, especially depending on the stage. So framing it as a pitch is generally a bad thing because it's one-sided. It should be a dialogue.
Cool. Now we can skip this stuff. Look, we're going to move right on to, thank you very much to our panelists. Give them a big round of applause.